Excuse me. So chapter 9 handouts on depreciation, and depreciation is for long-term things. It's not for things like inventory or anything like that. It's for things that are going to be there a long time. Piece of equipment, buildings, you know, automobiles, trucks, things that last for more than one period. So that's what we're going to be looking at for for chapter 9, and you should have it right now. It looks like this. Okay, so chapter 9. And again, we're talking about long-term things. We're talking about things that are more than 1 year. And again, you don't depreciate things like inventory. You know, inventory is an asset, but it's not a long-term one. Hopefully, inventory you'll sell for within a year or whatever. But so depreciation is allocated, and it's considered an allocation. It's not considered trying to find the value of something. So it's an allocation of the cost. In other words, we're cutting up the cost and putting some of it in each year that we're going to use the asset. Now, here's one thing though, it is not meant to find the market value. So we're not saying that this is the value of the item. We're simply saying that we're allocating this cost over a certain number of years. The market value may be higher or lower than what we're doing with it. Okay. And here's an example. Oops. Okay, they bought some equipment. A machine was purchased on January 1st for $800, and it has a useful life of 8 years. So the cost of the machine should be allocated to depreciation expense for the entire eight-year life. So in other words, if it's going to last for 8 years, we're going to expense it over 8 years. We're not just going to expense it all in the current year, you know, all $800, because it's going to last for a number of years. So we're going to expense it over however many years it lasts for. Okay. So it has an 8-year life. So here's how we would do this. So the cost would be 8. Let me color code these a little bit better. I'll color code them. So $100 should be allocated to each year to depreciation expense. Okay, not too hard. So every year, I know this is maybe a little bit over the top, but so every year we're going to depreciate $100. That's going to be expensed every single year. This will be on the income statement. For each year, you know, for everyone. So every one of these is going to be on the income statement. And you guys get the idea. Okay, so every year this will be on the income statement for $100 each year. $100 will be taken off the income. And again, that is this is what we're talking about, that every single year you're going to take a little bit off, so that as you use it over the 8 years, you're just cutting it up and saying, okay, we're going to expense a little bit every year for the 8 years of this thing. And again, you don't expense it all in the year you buy it. Okay. So, so this would be the expense for each year. This $100. So every single year you're depreciated by that. Okay, now depreciation, accumulated depreciation just keeps adding up. So this keeps adding up every single year as we add more depreciation. So this first one would look like this. So this $100 would be for, get it to do this correctly. It'd be that one. Let me do something with this one here. Let's make this, how about, okay, so this next one would look like this. This would be there's got to be an easier way for me to do this. Okay, so this is the first one. This is the second one. This might be more confusing than helpful. So every year we just keep adding more onto it. The depreciation just keeps going up and up and up. I didn't go all through 8 years, but you guys get the idea. Any questions on that? So the accumulated depreciation, we talk about something that's accumulated, something that you've, if you say, oh, well, I've accumulated, I don't know, artworks, that means that you've, over the years you've bought artwork or whatever. It's all of it together. So that's what this accumulated depreciation is, all the depreciation together. Okay. So depreciation expense is the same, in this case, the same every year, but the accumulated depreciation is all the depreciation to date. So by the end of year 3 here, right, this is all your depreciation to date would be this 300. Fix this or not. Okay, new plan. Let's make that. Let's make it yellow. Question on that thing? Okay. Well, the book value, by the way, these are all terms for the same thing. I know it's confusing, but so book value, carry value. net value. Basis is a tax term. They call it basis. And it's basically whatever you have it on your books for. So these all mean the same thing. There's nothing different about them. Book value is one we're going to be using. I think that's one the book uses, but carry values is used. These two are probably used the most, and they're pretty much interchangeable. These are used less frequently, and this one is only used for taxes for the most part. So in taxes, I call it the basis, what's on your books for. Okay. So the book value at the end of 2023 would be as follows. The cost of the machine of 800. We have our accumulated depreciation. Now 300. So this machine would be worth 800 minus the 300. So the book value would be 500. And again, this is not the market value. It is simply what they call the carry value or the book value, that it is what we have in our books at. The market value may be higher or lower than 500. It could be the same. It's not like it's completely out of the question, but it would just be a coincidence if it were. Question on that?
No.
Okay, good. All right. Getting into some of the terminology. Page 2. Residual value. Residual value goes by a few different names. Be salvage value, scrap value, terminal value, ending value. Those all mean the same thing. And what it is what is the asset worth at the end of its life? What do we estimate that it's going to be worth? So if we have a machine or a truck or whatever, and we're going to use it for however how many years, but at the end of that, it might be worth something still. If nothing else, we can sell it for the metal or whatever. So the residual value is an estimate of what it would be sold for at the end of its life. And it's reasonably be an estimate of the asset's cash value of its useful life. Now, this will reduce the cost of the asset. Because you're going to get it back. So if you think you're going to get back, well, maybe we'll go through the example. How about doing that? Okay. Yeah, we'll go down here to the depreciable amount. Okay, depreciable amount. This amount they're going to depreciate. Sounds an obnoxious thing someone would say to you. What's the depreciable amount? It's the depreciable amount. But it's the amount that we're going to depreciate on the item. And it's the net cost of the item. Now, notice something here, though. You have the cost, whatever it is, but we're going to get some money back. So this residual cash value, this residual value, this will actually be cash that will be returned to us. So whatever the cost is, we'll say, okay, the cost was, whatever, but we're going to get some money back. And so that's going to reduce the cost. And we're going to pay out a certain amount, and then so down here, the example is a truck costs $20,000. So the total cost of it is $20,000 of what we're paying for it. However, it has a residual value of $4,000. So in other words, at the end of its life, we're going to get $4,000 back. So even though we're paying out 20,000, we're gonna get 4,000 of it back. So that will reduce the amount we're gonna depreciate. So the truck cost 20,000. We paid out 20,000. However, at the end of its life, I don't think I put how long it's gonna last for, but whatever it's at the end of its life, it's gonna get $4,000 back. So the real depreciation, the real amount that we're gonna have to write off, basically, is that. It's only gonna, we're only gonna be paying out 16,000. This truck is gonna go from 20,000 down to 4. So we're really only reducing the value by 16,000. I know this is a lot. There's a lot of wacky terms in that, but and I'm positive I used this in class before. But why do we use the accumulated depreciation account? And this kind of illustrates why we did. I think I even used the same numbers when I did it in class. So you have two pieces of equipment. Equipment A and equipment B. And you'll notice that they both have exactly the same book value. Cost minus accumulated depreciation. The book value is 5,000 for each of them. However, which one would be more expensive to replace, A or B?
A.
Yep. A is obviously much more expensive. Which one of the pieces of equipment is older? Well, if you look at the accumulated depreciation, oops, you don't mess it up like I just did. If you look at the accumulated depreciation, much more of this A is depreciated than the B. B, it went down by 1,000, but it relative to what it costs, it's not nearly as much as this. This whole thing is almost depreciated. So this would be the same thing. This would be equipment A is older and will probably need to be replaced sooner. So it's very expensive and it probably need to be replaced. So even though the book value may look exactly the same for these two, if you look at the accumulated depreciation, you can tell a different story. That, really, this one, you're actually looking at a big cash outflow very soon, whereas this one, it's a lot less relative to this one, relative to A. And also, it looks like it's probably going to last a while. So again, it's just more information to give to managers, to the people who are, like yourselves soon. You want to make decisions and you want to look at the books and be able to know what you're looking at as far as equipment and all that stuff. Okay. So anyway, that's why we keep it. It's not. There's no error in thinking. Why do we do all this? Why don't we just, write the equipment down? Just every year take off $100 off the equipment. Theoretically, there's nothing wrong with that at all. The only reason why we use this, though, is that people get a little bit more information. You try to get as much information to people in management and decision makers so that they can make informed decisions. Okay. All right, different ways of doing. We're going to do two different methods of depreciating. What time is it? Okay. Straight line method. This is probably the most intuitive one. This is the one that, if no one ever told you anything about depreciation, this is probably the one most people would come up with, or something very similar to it. Okay, a truck was purchased for $32,000 on January 1st. Oops. It has estimated residual value. Okay, so this is what we're going to get back. Usually a cash sale. It could be a trade in too, but we're not going to worry about that. I'll put plus cash, right? So in other words, we're paying out 32,000. We're going to get 8,000 back though. And it has an estimated useful life of 5 years. Okay. Let me do something. Do some color coordinating here. Yeah. Okay. So first thing I'm going to do is find the depreciable amount. Okay, so this was a truck. The cost of the truck was 32,000. Bold all these. Now the residual value, this is money we're going to get back. It's going to reduce the cost. So this is cash coming back. Okay. And this will give us our residual amount. No, it won't. It'll give us our depreciable amount. So it's going to depreciate by 24,000. It's going to go from 32,000 down to 8. So the depreciable amount is what, 24,000? All right. Let's see here. So it's kind of like this. Give me 1 second. Oops. So if you kind of the chart out the book value of this thing, it'll look like this. Let's see how many years this is for. 5 years. Okay. So, here is it's going to start out at 32,000. Now, at the end of his life, it's going to be worth 8. So it's going to go from here, 32,000, down to here. Like that. So each year here is going to be. No, so each year is going to be worth a little bit less. Keep trudging down from 32,000. Okay, let's see here. Oops. Okay, so that's the depreciable amount. So it's going to depreciate by 24,000, and it's going to do that over 5 years. So how much will it be per year? Oh, come on, somebody has this.
1,600.
I think it's more than 24,000 divided by 5.
4,800.
Hold on. I asked a question I don't know the answer to. Let me try it again. So 24,000, excuse me, divided by 5. Yeah. Okay, so this will be divided by 5 years. Equal what, 4,800? So this will be the depreciation expense per year. So every year, we're going to depreciate this thing by 4,800. Okay, let me get rid of some of these rows here. Okay, our journal entries. If you recall, for depreciation, they're numbered by the very morbid DEAD, depreciation expense. And same thing, second year be exactly the same. Oops. Again. Okay. Now, for the tricky part. What's this thing? The truck. So I'll probably have equipment. You can also put this as truck. That's fine. Either one is fine. Okay, so it has 32,000. The depreciation expense in the first year would be 4,800. Now the accumulated depreciation is all the depreciation to date. So what would that be in the first year?
Zero.
At the beginning of the year, it would be zero, but at the end of the year, what would it be?
4,800.
Yep. Yeah, it's to start out as zero though, and because we bought it on January 1st. Oops, that's not the right number. Hold on. You go to 4,800. And so now here is how we find the book value. Let's see here. Probably a better way to show this, but. I had to go the other way. Oh, there we go. Sorry, guys. Okay, let's stop all this foolishness. Go back to the ones I know how to use. So you're going to subtract the accumulated depreciation, and that will give you book value. Okay, so 32 minus 48 is some number. $27,200. Okay. Now here's the tricky part. The equipment. You might be tempted to say, okay, it's worth 27,200. Actually, this account will stay at the cost for its entire life. And here's why. Because it's going to, the reduction is going to come from the accumulated depreciation, not from the account itself. We're going to leave the account on itself, the 32,000. Why? Well, the reason why we're doing this is that someone looking at these books will be able to know approximately how much this machine costs, and what it would cost to replace. Maybe is a better answer for that, and about how old it is. So we keep this on exactly at what we paid for it. So someone looking at the books will know exactly what we paid for this piece of equipment. Depreciation expense is going to be the same every single year. Okay, now for the tricky one, accumulated depreciation. This is all the depreciation we've had so far, all the depreciation expense to date in 2022, all of it together. So how much would be in the accumulated depreciation account?
9,600.
Yep. Add both those two together. Let me put some of my world famous graphics up here. It's a shame I can't trademark these. So all the depreciation expense to date is in this accumulated depreciation. Okay, so 32,000 minus 9,600 gives us some number. I'll give you more specifics here in a second. My calculator stopped working. It's just a calculator can. Okay, 32,000 minus 9,600. 22,400.
Yes.
Okay. Okay, and we just keep going down here now. That's going to be exactly the same. These are going to be exactly the same every year. This is not going to be the same. Okay, so for year 3, would be all 3 of these together. You could also just add the 48 onto the 96. That's another way of doing it. Okay, because this has the first 2 years, and you should just add the 3rd year in. Or you can do all 3 of it. Either way is fine. $17,600. And you get the idea. So if you come down here, you know, you see at the end of its life, it costs 32,000. This is the depreciable amount. And this is the residual value. Oops. Any question on that thing? So in your assets, at the end of 2021, at the beginning of 2021, it'll just be 32,000. At the end of 2021, we've had it for a year, it'll depreciate by 48. And it'll just keep going down until we get down here to the year 2025, which it'll be 8,000, which is what we, that's what we expect it to be at the end of its life. So in case you're wondering why it has the name straight line, it's sort of like this. Every year, it's going to go down by 4,800. So the first year it goes down to 27,200 at the end of year one, 22,400. In year two, and so on. So every year is going to go down by the same 4,800. So if you were to chart this out, it would be a straight line. Every year it goes down by the same 4,800. So it's going to go down to 8,000, and then here presumably we'll sell it and probably buy a new truck, I would imagine. So this is what the straight line they're talking about. That's what they're referring to. Oops. Okay. Let's go ahead and do the next one. We'll be quiet. Let you guys take a crack at it. Oh, I'm sorry. For this one, it's got useful life, so it's got 10-year life. Now come down here at the bottom. You just have to do this for the first 2 years. So you don't have to do all 10 years. We could do all 10 years, but just do the first. You just do the first 2 years. You just say no, like in business and that, when we in accounting, when we do this kind of stuff, it's you do what they call depreciation tables for each of them. By the time you get an asset in, right when you get it in, you'll do all the work, and then every year you just pull it out and go, oh, it's 4,800 for this piece of machinery or whatever. So you don't usually do these calculations every year for every piece of equipment. Okay, and again, that this is a straight line method, so, you know, every year we go down by the same 8,000 every year, we go out for 10 years. I'm not gonna do the chart, but it's the same idea though. It goes down by the same amount every single year, so it'd be a straight line if you, excuse me, look at the book value. Oh, hold on. Oopsie daisy. Let's try that again.
112.
Yeah, I'm sorry, but everybody, don't do what I did. I'm showing you things not to do today. So every year it goes down by 8,000. It'd be a straight line. Okay, this will be a good stopping spot. We'll do the, there's another method we're gonna go, units production. Do that tomorrow. Not tomorrow, Thursday. Any question on this? Again, this is a kind of easy concept, but this accumulated depreciation kind of makes it a little bit more tricky in that it's, you know, it's kind of like an extra step. It's there for a reason. It's not that it's just there, you know, frivolously stuck in there, but at the same time, it does make it a little bit more tricky to think about. One more thing I want to mention though, and that is, what's this thing, machine? Probably equipment. These two accounts, the equipment and the accumulated depreciation that go with it, these two are locked together. You know, this accumulated depreciation is a contra account. So this piece of equipment has this accumulated depreciation account. Those two are locked together. They go together. They can't be separated. You know, it's intrinsic. One is dependent on the other. So the equipment account will be locked in with this accumulated depreciation the entire life on the thing. And when they actually do end up selling it, they'll take both those off the books at the same time. So those two accounts, they go hand in hand for the entire life of the asset. So, you know, even though they are two different accounts, you know, but they are locked together because this accumulated depreciation is really a contra account to the equipment. So those two will go together forever. I mean, until they, you know, so at the end of this line, at the end of 10 years, they decide to sell this piece of equipment. You're gonna take both of them off the books, the equipment and the accumulated depreciation, which is a contra account to that piece of equipment. Question on that thing? Again, I know it's kind of strange. It's a, you know, it would be much easier just to write it, you know, just to, you know, basically have this book value be the equipment account, just expense it, take it off the book, and take it off the equipment. But again, the idea is that this accumulated depreciation gives more information to people in management so they can make better decisions. You don't want to have people making wrong decisions because the accounting isn't up to snuff. Okay, question on that? All right, well, that's it. The chapter 6 exam is due this Friday, I'm pretty sure.
Hey, Professor.
Yeah.
I actually never got the Chapter 6 exam sent to me. Have you sent those out yet?
I did. Mario?
Yes.
Okay, I will resend it. You can get into your Roosevelt account, right?
Yes, I checked. I got everything else from you, but I haven't got that for some reason.
Okay, Mario, I will do it immediately after we sign off here. Sorry about that.
No, no problem.
Is there anyone else that didn't get it? Okay, apologize for that. Okay, any other questions on this? No. Okay, but again, this is depreciation is not it's tedious. It's not. The idea is fairly simple, but it's just tedious to work with the accounts. But we will do more of it. Okay, well, I will see you guys on Thursday, and we will continue with this. Nothing to turn in from this class. And, I will talk to you guys on Thursday.
Thank you.
Thank you so much.
Thank you. Have a nice day.
I will. You too.